All right, well, good afternoon, everybody. We're going to go ahead and get started. My name is Randy Anderson. I'm with Traction Financial Partners, and we're going to talk to you about one of my favorite subjects today, and that is Social Security. We're going to give you a lot of information. It's going to be a lot to cover in an hour, but hopefully we'll give you some good information, add some value, and really maybe give you some things to think about when it comes to Social Security. If you have questions, I would go ahead and post them in the chat box there, the question and answer box. As we're going along, I'll try to pay attention to that, but I'm not really sure how successful I'll be at that. But we'll see how it goes. Also, just for future reference, we are recording this webinar, and it will be posted on our website at some point in the future. So. Let's talk about Social Security. See if I can get my screen to work here. There we go. So just real quick, kind of agenda, what are we going to talk about today? Just first couple minutes on a little bit of a more kind of light and fun history of Social Security. We're going to talk about the value of Social Security because frankly, I think it's quite underappreciated and there's really a lot of value that I think we take for granted. There's some specific benefits we'll talk about, spousal and survivor benefits that are really unique to Social Security. A big question we'll all have to ask someday is when should I begin taking benefits? And that's a huge decision. It's a huge decision that is a lifetime decision, and making a wrong decision can actually be quite costly. So we're going to talk a little bit about that. What happens if I want to work and receive benefits? We'll go through that real quickly, and then we'll kind of wrap up with just a couple of quick slides on taxes. And then the question we get a lot is the future of Social Security, the solvency of the program. And so we'll just briefly talk about that for a second. Okay, a couple of quick minutes of history. Franklin Delano Roosevelt signed the Social Security Act into law on August 14, 1935. The act created a social insurance program designed to pay workers over the age of 65. When Social Security started, the retirement age was 65 to begin collecting benefits. Who's this guy? Okay, Ernest Ackerman. He was the first person to receive a lump sum check from Social Security. So in the early days, in the first few years of Social Security, to accommodate those folks who hardly paid anything into the system, they were all given a lump sum check when they retired. So Ernest Ackerman, for example, had a nickel withheld from his paycheck because he retired one day after Social Security went into effect. He received a Social Security lump sum payment of 17 cents when he retired. So probably a pretty good return on his investment, but probably didn't do too much for his retirement. Ida Mae Fuller. She was the first person to receive a monthly benefit check in the amount of $22.54. She worked as a legal secretary and paid a small amount into Social Security. But one of the interesting things about Ida Mae, one of the benefits of Social Security is that it pays you for as long as you live. Ida Mae Fuller lived to be 100 years old, dying in 1975. During her retirement, she collected nearly $23,000 in Social Security benefits. Kathleen Casey Kirschling is known as the nation's first baby boomer. She was born 1 second after midnight in 1946. A retired school teacher, she decided to start collecting benefits when she turned 62 in February of 2008. 62 at that time was the earliest, and still is the earliest age that you can start taking Social Security benefits. All of the national media reported on it, all the major publications of the day. And Kathleen Casey Kirschling kind of gave the impression that maybe everyone should start at 62 when they turn at the earliest retirement age. And we'll talk about whether that's good advice or not. And then, of course, over the next 2 decades, over 80 million Americans will be eligible for Social Security, sometimes referred to as the silver tsunami. Believe it or not, today, over 11,000 people turn 65 every day in the United States. Couple of quick key dates in Social Security history. In 1950, was the first COLA added, and it was a one-time COLA. Basically, it was a 77% COLA to account for all of those basically inflationary periods from when the program started. 1956, disability benefits were added. In 1961, the earliest retirement age was reduced from 65 to 62. Medicare falls under Social Security. That was added on June 30th. And then in 1972, automatic cost of living adjustments were added each year. In 1983, some taxation was added to some Social Security benefits. We'll talk about that. And then in 2000, retirees were allowed to work after full retirement age and collect benefits without penalties. All right, let's talk about the value of Social Security. I'm going to see if I can adjust my screen a little. Thank you. The value of Social Security. So Social Security was never meant to be your entire retirement income. It's something that is meant to be a supplement to your own savings, your own investments, and that type of thing. So unless you have a pension, or you might have an annuity that has some kind of guaranteed lifetime income, one of the unique things about Social Security is that it provides income you simply can't outlive. Not a lot of assets do that, not on a guaranteed basis. Now, why is that important? Well, a couple of statistics for you. So a man turning age 65 today, on average, will live another 18 years. A woman will live another 22 years. A couple turning 65 today, the chances that one person of that couple will live past the age of 90 is over 80%. 1 in 3 people will live past 90, and 1 in 7 people will live past the age of 95 who are turning 65 today. Having a benefit that lasts for your entire lifetime, just like with item A Fuller, huge benefit. Second, it provides income that's inflation adjusted. So we just noticed that cost of living adjustments were added annually and become automatic. We've seen that in the last couple of years where we've had a little bit of higher inflation, and the cost of living adjustments with Social Security have been quite high. We all know things increase in price in the future. What you could buy 20 years ago, your purchasing power today just won't buy. So when we have a benefit that is inflation adjusted, again, a terrific thing. It provides unique spousal survivor benefits. We're going to talk about those in a little bit more detail in a minute. So we're going to skip that for right now. And then finally, when we're getting Social Security and we get that monthly deposit into our bank and we spend it on our basic needs, we spend it on things that we need to buy. And I think that money comes in, it goes out, and we don't really realize how much the benefit pays you over time. So the chart below, in 2024, the maximum monthly benefit, this is for a person collecting benefits at their full retirement age, which currently is between 66 and 67, is $3,822 a month. I took that monthly benefit and I calculated using a cost of living increase of 2.8% a year, which is the historical average for Social Security, just to see how much the benefit totaled after time periods. After 10 years, you can see the benefit you're going to get paid is about $521,000. After 20 years, $1.2 million this person will have received from Social Security. And after 30 years, becoming a little bit more common, still a long retirement, but after 30 years, over $2 million in Social Security benefits. Those are some pretty huge numbers. So one of the things I always want to kind of emphasize during this webinar is that don't just look at Social Security as kind of that payday coming in and payday going out. Think of it as an asset. This is an asset that you really need to plan around with some of your other stuff. Don't just think of it as a total separate entity, because it's a large sum of money that typically is paid out over the course of time. In 2024, the average monthly benefit is $1,909. So granted, the chart I used here was using the 3,822 number. The average is pretty much exactly 1/2 of that. So even given those numbers, payout after 10 years, we're looking at over $260,000. After 20 years, $600,000, after 30 years, over $1 million. For that person who is getting that average Social Security benefit, that is also a pretty large sum of money. So think about that. The benefits are quite valuable, and we just kind of need to keep that in mind when we're talking about Social Security. All right, how does it work? How do they calculate your benefit? So the benefit is based on your highest 35 years of earnings. All those earnings are indexed to those years' inflation. And when we divide our earnings months into our years, our highest 35 years, we get what's called the average indexed monthly earnings. That's the AIME. Now, Social Security puts this through a formula, and they use 3 bend points in their calculation. Now, hopefully you can see my mouse here so I can point out a few things. So the first bend point is $1,174. Everybody, their first $1,174, that number is multiplied by 9%. And in this person's example, we're using an example of a person who had an average indexed monthly earnings of $7,150. That amount equals $1,056.60. The next bend point is $7,078. The difference between $7,078 and the first bend point of $1,174 is $5,904. That number is multiplied by 32%. In this example, we get just over $1,889. And then if your average indexed monthly earnings is higher than the 778, as in this example, it's $72 higher, the remaining is multiplied by 15. And in this case, we get $10.80. We add these numbers up, and that comes out to $2,956.68. That is what's known as your primary insurance amount, your PIA. In other words, this is what your benefit will be if you wait to take Social Security until your full retirement age, which currently is between 66 and 67 years old. Just to clarify that, all people born after 1960, your full retirement age is 67, and then before that, it's prorated a little bit. So that's how they come up with the calculation. The calculation is really meant and is really built so that people who were lower wage earners during their earning years, actually Social Security pays a slightly higher percentage of kind of their retirement benefit needs. Higher income earners, Social Security is going to cover less of the expenses that they're going to need in retirement. So there's a method to the madness, and there is an actual calculation, and there you have it. And we're done with the math for today. All right, your Social Security benefit. Your Social Security benefit is really important. This thing is very accurate, particularly the closer you get to Social Security. It's very accurate to help you determine what your benefit's going to be. And again, when it comes to planning your retirement around financial planning and that type of thing, it can be very beneficial to know these numbers. The first thing I would tell everybody to do, if you haven't done it already, is create an account at Social Security. You do that by going to ssa.gov. Put in your information. It's going to ask you some personal information so that it knows it's you. And then you'll create your password so that you can have access to this benefit statement all of the time. Really important to do that. You can kind of sidestep it a little and get an estimate of your retirement benefits by going to the same website, ssa.gov, and clicking on the button that says estimate your retirement benefits. But really, to see your actual statement, this is going to give you a lot of really good information. So let's look at the statement somewhat quickly, but go over a couple of things. Lots of great information. First of all, your retirement benefits tells you right here what your full retirement age is. It tells you what the impact of starting early versus starting late will do. Provides you a lot of good information. It's also going to give you information about disability benefits if you become disabled. And then upon a death, it also talks about survivor benefits down here. It gives you some good little information here on Medicare. When you turn 65, you need to sign up for Medicare. You even want to do that if you still have current health coverage with a company, because if you don't, you won't have to pay any premiums, but you could eventually pay lifetime late enrollment fees. So we don't want to do that. The most important thing I want to show you is the chart up here, where it's actually going to show you your personalized monthly retirement benefit. These are estimates based on your current earnings, and it's based on whether your earnings stay the same. In this person's case, Wanda Worker, it's based on earnings of $54,489 a year, and that is typically the earnings that were last reported to Social Security, probably in the last tax year. So I want to point out the different benefit numbers here. I apologize for the small screen here, but I'll read you the numbers. At age 62, if Wanda starts taking her Social Security benefit, her monthly benefit is estimated to be $1,465. Now, if Wanda waits until she's full retirement age, and for her that's age 67, her benefit will increase to $2,119. From age 62 to age 66, your Social Security benefit increases roughly 7% a year. And from age 66 to 70, it increases 8% a year. That's a pretty darn good return on your investment, which becomes lifetime income. If Wanda waits until age 70, her benefit is $2,634. Now, one of the things I want to point out here is look at the difference between 62 and 70. It's over 80%. It's almost double. It's a huge increase. And when we're talking retirements of 20, 25 years, that difference can be huge. It also will have an impact on a survivor benefit that we're going to talk about later. Page 2 of your Social Security benefit is basically your earnings record. So it's going to show you right here in the middle all of your earnings years. The last 15 years or so, it's going to show you each year. It's going to show you your reported taxable earnings for Social Security. In the earlier decades, you can see by decade, they just combine them. Now, when you have your account on Social Security, you can go out on the website and you can get the individual years for all of these. They just do this, obviously, to be able to fit it on the statement. It's important to just kind of glance through this and make sure it looks accurate. And typically by accurate, I mean, do you see any zeros? Do you see zeros where, wow, I know I worked that year, but why do I not have any reported earnings? And that's important because if we don't have earnings in certain years, that affects our average index monthly earnings, right? And ultimately our benefit when it gets to full retirement age. So errors can be easily corrected, and errors happen. You get a new job, HR messes things up, you get married, there's all kinds of things that can create these problems. But errors can be easily corrected by setting up an appointment with Social Security, taking proof of your income, W-2 form, tax returns, company letter, etc. And I've had several clients tell me that Social Security actually fixed that right there in their meeting while they were sitting there. So very important to do this just to make sure that you're overall accurate. One thing to note here is there's a wage cap for Social Security taxes. And in 2024, that wage cap is $168,600. What that means is that if you earn more than $168,600, any earnings above this cap, you are not paying into Social Security taxes. You are still paying into Medicare, but you no longer pay into Social Security when you have the income above this. A couple other quick things on this statement. It's going to show you the taxes paid. I get this question a lot. Wonder how much have I paid into Social Security? Well, in the case of Wanda Worker here, she's paid in $75,000 into the Social Security system. Her employer has paid in $77,000. And as you probably know, the rule is that when you have payroll taxes through FICA deducted from your payroll, you pay half of Social Security amount and your employer pays the other half. Currently 6.2% for you and your employer. The other thing to note, that just make a quick comment, a lot of people always who start taking their Social Security early, which may in fact not be the best decision, always a lot of times will say, well, I want to make sure I get everything out of Social Security that I paid in. Well, I'm going to tell you, in most analysis, once you start taking your Social Security benefit, it only takes about 3 years, maybe 4 at the most, to get out everything you paid into Social Security. So through a lifetime of retirement, Social Security certainly is a very huge benefit. Up in the upper right corner here, This talks about earnings not covered by Social Security. So this is for folks who have a pension, a government pension, they might have a para pension, in which their employer did not participate in Social Security. And those folks might be, we're going to talk about this briefly a little later, so I won't go into it now, but they may be impacted by what's called the windfall elimination provision, where your Social Security benefit is reduced a little. And it might also be impacted by the government pension offset, which means that as a survivor or a spouse, your Social Security could be substantially reduced. The bottom corner here, just a couple of other great tips. How many years? You need 10 years and 40 credits to qualify for Social Security. Talks about retirement benefits and a few other things. So bottom line, go online, create your account, make sure you can get this Social Security statement, because if you're under the age of 60, they're only going to mail this to you every 5 years. And again, it's a very helpful document going forward. All right, before we jump into a couple of the details of a couple of the benefits, let's just talk about a rule that changed because of the Bipartisan Budget Act of 2015. The concept of deemed filing was put into place. So prior to 2015, a person could apply for example, a spousal benefit, and they could collect money from their spouse's Social Security while they delayed their own benefit, or they could do vice versa. Basically, you could kind of pick and choose whose benefit you wanted to start with. Well, that all changed in 2015. The deemed filing rule applies to all people born after January 1st, 1954. And what the deemed filing rule basically means is that when you file for either your retirement or your spouse's benefit, you are deemed to be filing for all benefits available to you. So you no longer can go out and apply for one benefit and allow your own to delay. When you apply for Social Security, you are applying for any benefits that are available to you. Now, deemed filing only applies to retirement benefits. It does not apply to survivor benefits. And though that's a kind of another unique benefit that we're going to talk about here shortly. So we always want to remember the deemed filing rules that are now in place. Let's talk about spousal benefits. So spousal benefits have been around since the very early years of Social Security. And what spousal benefits do is they benefit a spouse who may have not worked outside of the home, which was fairly common in the early years of Social Security. So a spouse who has no earnings in Social Security is eligible for this benefit. It can be for a spouse who worked a little bit but doesn't have the 40 quarters required to qualify for Social Security. Or it can just plain be beneficial for a spouse whose benefit is fairly low. So that's kind of where the benefit came into play. Now, the rule is a spouse will get the higher of their own benefit or a spousal benefit. So a spouse can get 50% of the primary worker's benefit. And when we talk about 50% of the benefit, that is what you would receive if you are eligible for a spousal benefit at full retirement age. Just like anything else with Social Security, we'll talk about this more, but if you start your benefits before full retirement age, your benefits are reduced. And that is the same with a spousal benefit or any other benefit. So that's one of the things we really want to be careful of if we are starting a Social Security benefit early. Let's take a look at how this works with Bob and Sally. And we're assuming Bob and Sally are both age 66 and are at full retirement age. Bob's benefit is $2,800 a month. Sally's own retirement benefit is $1,000 a month. Sally's spousal benefit would be an additional $400. How do we get there? Well, 50% of Bob's full retirement age amount is what Sally is eligible for with the spousal benefit. So half of Bob's $2,800 is $1,400. If Sally's benefit is below $1,400, she will receive a spousal benefit bump to get up to that $1,400 a month amount. Both now with the deemed filing rules, both Bob and Sally will have had to start their benefits. What if Bob delayed till the age of 70, which for a married couple, we'll talk more about this, not a bad idea, because it can really increase your benefit and also may become a survivor benefit at some point. But let's look how it works. Sally would start collecting her benefits at age 66, and she would get $1,000 a month. Bob, remember, is not collecting his benefits because he's going to delay to age 70. And by doing so, his benefit will increase to $3,700 a month. Now, once Bob starts, Sally will start getting that additional $400 a month to get her up to the 50% of Bob's full retirement age. The important thing to remember here is with spousal benefits, the 50% rule is always on Bob's full retirement age. So for 4 years here, while Sally is waiting for Bob to get started at age 70, she will get her own retirement benefit of $1,000. Hopefully that makes sense. But it also points out one of the reasons that we do want to consider delaying, particularly for the married couple who has a higher benefit in the household. Now, side note, former spouses, divorced spouses may be entitled to spousal benefits as well. So if you were married for at least 10 years and you have not remarried, then you are also eligible for this benefit. The spouse in which your benefit is being requested can be remarried, and in addition, they do not have had to start their Social Security benefit. So the slight change for divorced spouses is that their ex does not have to have started their Social Security benefit, and their ex can also be remarried. But the same rule applies in this situation. If this exact same situation happened, but Bob and Sally were divorced and Bob was off remarried, same thing happens here. Sally would be able to collect $1,400 off of Bob's benefit because they were married, we're going to assume, for as long as 10 years. I've had some people ask me, well, what if I have more than one spouse that I was married to for 10 years? Good question. You get to pick the highest spouse. So for an example, Johnny Carson, dating myself here, Johnny Carson was married to 3 different women for longer than 10 years. All of those women could be getting a spousal benefit on Johnny Carson's benefit. So very interesting, unique benefit that Social Security has to offer and can be quite beneficial to add additional income to the household when we're talking about a spouse who had again, didn't work outside the house or had a lower benefit. Survivor's benefits. Survivor benefits are very unique. Basically, a surviving spouse will receive the higher of either their own benefit or their deceased spouse's benefit. Basically, the higher benefit in the household is the one that will continue and the lower benefit will go away. So pretty simple. Let's take a look at Bob and Sally again here. Bob's benefit is $2,800 a month. Sally is receiving $1,400 a month. Bob passes away. Sally will begin receiving $2,800 a month. Social Security has to be notified, but upon the passing of a spouse, funeral homes basically are required to contact Social Security. So they pretty much already know when you make that phone call. The important thing to note here is that obviously the monthly household income coming in is going to be reduced by $1,400. Sometimes that can be significant, and good planning can help work around that. Delaying the higher spouse to age 70 can be substantial. So in financial planning, we might look at starting Sally's benefit a little early, like we kind of did in this situation, getting her that spousal benefit later on. But if Bob delays to age 70, his benefit is now $3,700 a month. That will become Sally's survivor benefit, and her benefit of $1,400 will go away. So one of the strategies we always want to look at in financial planning, at least initially, is for a married couple, whichever person has the higher Social Security benefit, delaying that benefit for as long as possible is generally a very good strategy, because at some point in the future, that benefit will become the survivor benefit. So really important to think about that. Surviving spouse must be at least 60 years old. You must have been married for at least 9 months prior to death. Now, the other quite interesting thing about survivor's benefit is that there's some unique strategies that you can still employ with a survivor benefit. Deemed filing does not affect survivors' benefits. So deemed filing, as you remember, means that when you file for Social Security benefits, you're deemed to be filing for everything available. Not the case with a survivor benefit. Survivors have multiple options for claiming benefits. So consider it this way, survivors have two benefits. They have their own retirement benefit. Just like normal, they can start as early as 62, they can delay till age 70, that's their own benefit. But then they also have the survivor's benefit from the deceased spouse. With a survivor's benefit, you can start as early as age 60. And the other thing you can do is you can kind of play with who has the higher benefit, and you can start one or the other and then switch to the other later on in life. So this is really, really important, somewhat complicated, and it really takes some good financial planning to kind of figure out the best strategies here. But let me give you just a couple of examples. A survivor, for example, could claim their own retirement benefit at age 62. And then at full retirement age, when they turn 67, they could switch to the survivor's benefit. And we would do this if the survivor's benefit is larger, right? Another example, an individual could claim their survivor's benefit as early as age 60. So in this situation, perhaps the survivor's benefit is lower than my own benefit, but then you can switch to your own retirement benefit as late as age 50, taking advantage of all those delayed credits and the much higher payments. A couple of notes here. In any case, whenever you start below full retirement age, so in this case, age 62, or in this case, age 60, your benefits are going to be reduced because anytime you take it, they're reduced prorated each year. I'll show you a chart on that. I'll show you a chart on that later. And also, if you're still working, you could be penalized if you earn too much. So we always have to be very careful about when we're going to start these benefits. But there are many, many strategies within here for a survivor in which we can really maximize benefits over the course of time. Okay, when do we start taking Social Security? Big question, important question, one everybody has to make. And to start off with, I'll let you know that the general philosophy is that most people, many people, start taking benefits too early, thus costing them literally thousands and thousands and thousands of dollars in benefits. So for example, starting at age 62, you are telling Social Security, I'm willing to take a permanent reduction in benefits of 25% to 35%. The difference here is if your full retirement age is 66, your benefit is reduced by 25%. If it's 67, it's reduced by 30%. That is a permanent reduction, and it also can have a impact on spousal benefits in the future, and of course, survivor benefits. At normal retirement age, or 66 or 67, whatever your full retirement age, you receive 100% of your primary insurance amount. Remember that amount we looked at earlier. So again, increases almost 7% a year. And if you delay till age 70, the benefit increases another 32% from age 66. As we saw on Wanda Worker's statement, this is huge. It's almost 80% higher than from at age 62. So we want to be really strategic about when we're thinking about starting Social Security. Believe it or not, 1/3 of all Americans start their Social Security benefit at 62, and 60% of all Americans start their Social Security benefit sometime before the age of 66. That, in my opinion, for most people, is kind of crazy. You are really giving up some potential long-term benefits. Now, when we're talking about a couple, we might strategically start one of the couples earlier and delay the other couple who has the bigger benefit. But that's something you really want to do with planning. In my experience, many people start their benefits early just because they just feel they need to start the benefits early because they want to make sure they get everything they paid out into Social Security and those things. And again, it can be very costly. Keep in mind increased longevity, as we talked about. For a married couple, the chances that one person could live past 90 is almost 80%. It's huge. So we want to think about that, particularly with the spouse that has the highest benefit in the household. That benefit's going to be a survivor benefit. If the surviving spouse lives another 5, 10 years, that could be huge. And so I mentioned here, higher benefit, huge for survivor. One of the things you can do is calculate your break-even age, which I've kind of done for you here. If you start at age 62, how long do you have to live basically until you would catch up to your benefits as if you had delayed? At age 62, your break-even age is 80. At full retirement age, your break-even age is 78.5, and at 70 is 80. So when we look at longevity, the chances are anymore that you're going to live past 80 are getting pretty high, and that occurs for a majority of the population anymore. So we really need to think seriously about when we want to start our Social Security benefit. Factors to consider when taking Social Security. Marital status, obviously, we've talked about that. If you're married, really need to think about the higher benefit in the household really being a benefit that's going to probably last a second life, and that's the surviving spouse. What is the current health, your spouse's health, estimated longevity based on family history, health, that kind of thing. What are your cash flow needs? If your cash flow needs are that we need to start Social Security because in order to meet our retirement expenses, our monthly expenses, pay the rent, whatever the case may be, we may not have any other choice. But if we do have a choice and we can go without collecting right away because we have sufficient cash flow, then we need to think about that. Are you still working? If you're still working, you can be penalized before full retirement age for taking Social Security. We're going to talk about that here in another slide in just a second. Government pensions, we'll talk about that as well, because your Social Security could be reduced because of government pensions. We always want to keep taxes in mind, obviously, when we're looking at all this through a planning process. And then finally, we need to look at our other retirement assets. As we talked about earlier, Social Security is meant to be a supplement to all of your other stuff that you're saved, your savings, your IRAs, your 401ks. And there's a lot of research lately that says that just because you're quitting your career or you're leaving your job and retiring, doesn't mean that's the moment you have to start Social Security. There's nothing wrong in thinking about tapping into your own retirement funds, your IRAs, in order to delay Social Security for a couple of years or 4 years up to age 70. And the research is showing this is quite possibly a very smart decision. My screen just went blank. Hang on, guys, we're having some technical difficulties here. What's happening here? Hang on. I'm getting the technicians in here. It just went blank. Black. Hang on, guys. We'll be right back with you. Should try starting sharing. Hang on, folks. All right, guys, I think we're back up. Not really sure what happened there. Hopefully everybody can see the screen now. I'm going to flip through and get to where we were. So anyway, talking about when we want to start retirement, Social Security. So we talked about other retirement assets and why it may be very beneficial to look at those assets in order to delay Social Security. It may be beneficial for this reason. Delaying and taking your own money for a while means a substantially larger Social Security benefit, and Social Security has a preferred tax rate. In other words, 100% of your IRAs and 401ks are taxed when you withdraw from them. Social Security cannot entirely be taxed. Only up to 85% of your benefit can be taxed. So there's a slight tax rate benefit here. Second, the larger Social Security benefit guaranteed for life with annual cost of living increases. It's not necessarily the case with your IRAs. Obviously, with good investment management, we hope to grow those IRAs as well. But Social Security, probably the greatest annuity on the market today, guaranteed for life with annual cost of living increases. Withdrawals from your retirement assets may be leveled or reduced slightly when you're taking money out of it early for a few years in order to delay Social Security. Remember, currently at age 73, the IRS comes calling and you are required to take some money out of your IRAs. And again, the long-term potential tax savings can be quite substantially, as the research is showing. I put a quote here that I thought summed it up quite nicely by Reichenstein and Meyer, who are some Social Security analysts. And basically they said, many people could lower their lifetime tax bite, collect years of higher Social Security benefits, and extend their portfolio longevity by delaying Social Security and taking larger IRA withdrawals in the early years of retirement. It's certainly something to think about, and it's something to consider when you're meeting with your advisor and your financial planner. This chart, just look at this quickly. This is kind of a visual chart that shows you the reduction in your Social Security benefit if you take it before full retirement age, and each year the 8% increase in Social Security benefits after full retirement age. So the difference between here and here can be quite substantial. All right, last thing here, what if you want to stop taking your Social Security? What if you see my webinar and you go, oh gosh, maybe I made a mistake and I should not have started at age 62. Well, you can stop it as long as you do it within 12 months of starting your benefit. And you have to repay all the benefits you've received back to Social Security. So this is something that very, very rarely happens, because most of the time when we've started, we've kind of spent the money and we're really not looking at giving Social Security money back. But if you did this in the first 12 months, then your Social Security will be delayed, just as if you didn't start. Now, after full retirement age, you can suspend your benefits and allow them to accrue as late as age 70. Remember, in all these situations, if you stop your benefits, that may impact spousal benefits that you're currently receiving. All right, real quick, if you have a government pension, I don't know how many people on the call may have a government pension of some sort where they didn't pay into Social Security, yet they may also have Social Security credits and are eligible for Social Security. So the windfall elimination provision basically impacts the person who has the pension, and it only impacts your retirement benefits. So benefits may be reduced based on how many years you paid into Social Security. If you paid into Social Security for more than 30 years, your benefit is not reduced. But anything less than 30 years, your benefit is reduced slowly down to 20 years of paying into Social Security. In 2024, the maximum reduction is $587 or 50% of your benefit. So you'll never lose all of your Social Security benefit, but it could be reduced. The bigger impact is the government pension offset. This impacts spousal and survivor benefits. What happens here is if I'm a person receiving a pension and my spouse passes away, as we saw earlier in typical, I would get some of my spouse's Social Security. But when you have a government pension, they take 2/3 of that pension amount, and that's the amount that you cannot claim as a survivor benefit or a spousal benefit on Social Security. So for example, if I have a para benefit and I earn $3,000 a month and my spouse passes away, Social Security will look at my $3,000 a month, take 2/3 of that, which is $2,000. And if my spouse's Social Security benefit is less than $2,000, a month, I will not receive any pension or any Social Security survivor's benefit. If her Social Security was above 2,000, let's say it was 2,300, then I would get 300, but the 2/3 government pension offset. And this can be a pretty huge thing that really is something to really look at with planning as well. Working while receiving benefits. So before your full retirement age is when this takes effect. So basically what happens is if you are working and you decide to collect Social Security benefits, there's an earnings limit. In 2024, that earnings limit is $22,320. For earned income that you earn over $22,320, you will lose $1 in Social Security benefits for every $2 over the limit. So let me give you a scenario. Bob is 64 years old and he's going to semi-retire this year. His normal retirement age is 67, and he elects to start his benefits early at age 64. His monthly Social Security benefit is $2,600. Bob is going to work part-time, earning $28,000 a year. He's also going to receive $10,000 in investment income, dividends or something like that from his investments. Now let's see how the calculation works. Earned income. So the $10,000 Bob gets from his retirement assets do not count in this calculation. It's only W-2 income and 1099 income. And Bob is going to earn $28,000 at that part-time job. Well, the Social Security limit is $22,320, which means Bob is going to earn $5,680 over that limit. As we just learned, for every $2 over, you lose $1. So that means we divide 5680 by 2. And so Bob's Social Security benefit will be reduced by $2,840. So it's one of the things we want to look at when we're talking about starting early. And a big one is whether you're still working. After full retirement age, there's no earnings cap and no penalties. You can make as many dollars as you want after full retirement age, and there are no penalties. Now, the good news is if you are kind of in a cash flow crunch and you need to start your Social Security early, this isn't such a bad thing because you still receive some Social Security benefit, and the benefits are really not lost, but they're deferred. At normal retirement age, Bob's benefits will be recalculated to begin recouping benefits lost prior to age 67. So the bottom line is going slightly over the limit is okay if the benefits are needed, but obviously if you are going to earn a lot over the limit, $40,000, $50,000, it would nearly wipe out your Social Security benefit. So it's probably not a smart idea. Quick word on taxes. In 1983, initially taxes on Social Security were implemented up to 50% of your benefit could be taxed. And then in 1993, an additional tier was added to this to where up to 85% of your benefits could be taxed. This is off of your adjusted gross income. So this is going to include any earnings. It's going to include retirement withdrawals from your IRA, dividends, etc. And then 1/2 of your Social Security benefit goes into the calculation. If you're single, head of household, once you go over 25,000, 50% of your Social Security can be taxed. Over 34,000 is 85%. If you're married filing jointly, once you go over 32,000, then up to 50% of your benefits could be taxed. And over 44,000, up to 85% of your benefits could be taxed. The interesting thing here is when these two taxes were implemented, there was no inflation factor put into this. So these numbers are the same as they were back in 83 and 93, which is kind of ridiculous because at that time, this didn't impact a lot of people. But of course, today, a majority of Americans are taxed on Social Security because of earnings over this amount. It is something they're looking at. In fact, there was recent legislation introduced into Congress that says to eliminate taxes on Social Security. So we'll see where that goes. And that's kind of it on the taxes. Last thing I want to talk about is the solvency of Social Security. Lots of misinformation out there. Lots of things out there saying, oh, it's going away. I got to get my money, blah, blah, blah. So just let's kind of look at the facts. Social Security in 2018 started paying out more in benefits than it collects in taxes. In 2021, taps into the trust fund principle. So Social Security has a trust fund in which all of the benefits from payroll taxes, mostly from payroll taxes, are held. That trust fund, according to the 2023 trustees report, that trust fund will be exhausted in 2033. So after 2033, if nothing is done to fix Social Security, then projected benefits will be reduced by 23% because the benefits will strictly be paid by current employees working at work and paying FICA taxes. So now I'm a firm believer that at some point we'll get our heads together and we'll figure this out because I just don't think this will happen. There are 60 million people currently collecting Social Security. And if all of those people were severely impacted, I would not want to be the politician who ran on that platform. How do we fix Social Security? Lots of things we could do. We could continue to raise the retirement age as we are now. We could increase the cap on taxable earnings. Remember, once you earn over 168,000, you no longer pay into Social Security. Some people say there shouldn't be a cap. Some people say if you make $1 million a year, you should just have to pay more into Social Security. We could do absolutely nothing and lower benefit payments by 23% after 2033. Again, I don't think that's going to happen. If that did happen, I've often been asked, how long would Social Security actually last? And currently, Social Security would last pretty much for this century. So it means most people retiring now or in the next 10 or 15, 20 years probably are safe. We could review the FICA tax rates. So FICA tax rates, this is the deduction that's taken out of your payroll. 6.2% that you pay, 6.2% that your employer pays. This in 1991 was the last time the FICA tax was ever changed, 33 years ago. There has been, Fidelity did a research project that said if we increase this by 1% over the course of 10 years, that Social Security could maybe be made whole in the next 50 to 100 years. So there's things like that that could happen, but we'll have to see. And I did mention potential new legislation. This actually has been introduced that would eliminate taxes on Social Security benefits completely. And it would also increase these FICA taxes on high income earners. The research paper associated with this new legislation said doing this would delay the trust fund from basically going bankrupt for another 50 years. So that's pretty substantial, but we'll see what happens. But there are things we can do to fix Social Security. I'm a believer that that's going to happen, but the longer we wait, the harder it becomes. And so we'll see what happens. Finally, don't look at Social Security in a vacuum. I want to wrap up here by just kind of going back to my point throughout the presentation is that Social Security, don't look at it as just a check coming in to be spent. It's a large sum of money. And in fact, if you look at in financial planning, we look at a 4% withdrawal rate, which means if you take 4% withdrawals out of an investment, theoretically that investment would last without running out of money for your entire retirement. Well, if we look at the person that we looked at earlier who has a $3,800 monthly benefit, that's equivalent to having an investment account of $1.15 million. So think of Social Security as an asset that really needs to be planned around. Starting too early can cost you thousands of dollars. When we say tens of thousands, even hundreds of thousands in some cases. So a comprehensive retirement plan can be of great value. Coordinate and integrate things like your Social Security, your personal savings, investments, whether you have a pension, taxes, estate planning, all this stuff can be put together as part of a comprehensive retirement plan, and Social Security strategies can be part of that plan. So I think really important to think of it in that way, as opposed to when can I start, can I start doing that, and how does it impact the rest of my retirement? This is the disclosures. I'll let you read that real quick. And then finally, If you have any questions, I see it looks like there might be a question in the chat box. If you have any questions, feel free to contact your financial advisor. I'm willing to answer questions for you too if you want to email me at randy.anderson@tractionfp.com. And for a PDF copy of the presentation, you can contact Katie Cappius here at our offices. So let me see if I can see what this, let's see here. I have a pension plus Social Security. If I die first, but my husband isn't getting survival pension dollars, can he get some of my Social Security as a survivor? Yes. So the answer is you have the pension. Your husband does not have the pension. So he is not impacted by the government pension offset. So depending on the size of your Social Security, if your Social Security is higher than your husband's, then yes, he will get that Social Security as a survivor's pension if you pass before him. Okay. Any other questions? Ron, thank you very much. Appreciate that. Any other questions before we sign off here? I'll give you another minute here and again, if you have any questions in the future or you think about things, feel free to reach out to us. I'll be happy to answer those for you. All right, folks, I think, let's see here. 1:57, finished right on time. It looks like we probably don't have any more questions, so I'm going to go ahead and end the webinar now. Thank you so much for sitting in and listening. I hope you learned some good information. I hope you got some value out of this. And again, this webinar, I believe, will be posted on our website at some point in the future. So thank you again. Have a great day, and we'll see you soon.